Good morning, everyone. I'm Steve Ankerstar, and welcome to the Ankerstar Wealth Morning Show. Today, we're going to talk about the how this is currently like the best recession ever, and I say that kind of jokingly, but we are in a recession, if you will. I know the government hasn't declared it, but by traditional terms, two consecutive negative GDP quarters, we're in a recession, right? So if we are in a recession, by the standard definition, this is the best one ever, right? Because people aren't feeling it nearly as much as they would during a normal recession. So we're going to look at kind of the older recessions and talk about why this one is different. Secondly, we'll also talk about how home sales, and again, I know it's a touchy topic for folks, but home sales were negative for the first time in 3 years, and the amount that we were down was the worst since 2011. So again, going on 11 years there. So did the housing market bubble? Yeah, of course it did. It was kind of obvious when you're not in the mood to buy or sell your house, so you can kind of watch this as an outsider. But sure, home prices went crazy. Good on everybody who was able to sell at that point. If you bought, you may be upside down in your house for a little while or sometime. We don't know, depending on how far prices will fall. But even in on fire markets like here in Austin or Scottsdale or Denver or some of the other places that are kind of known for their on fire markets will stay on fire forever, right? So we're going to talk about that, and I will show you some numbers there. And then lastly, we're going to talk about Tesla's 3-for-1 stock split today and what I expect to happen with the stock there. Before we begin, as reminders, a financial education presentation and should not be construed as personal financial advice. Full disclaimer information is available at ankerstarwealth.com. All right, Allison couldn't make it this morning, or she chose not to make it because it's her birthday. So happy birthday to Allison out there, and we will see her back either Friday or next week. Obviously, she's in school and I'm busy with that. Okay, let's talk recessions. This is Investopedia right here. And, the meeting I went to yesterday is with First Trust, who obviously has some very smart people. Otherwise, I wouldn't follow them. But they were talking about how this is the best recession ever. And, and I'm having fairly young girls. I'm familiar with the One Direction song, best song ever. So I kind of had the best recession ever ringing through my head yesterday. But when you look at, we talked in the open about the definition, 2 negative quarters of GDP, and then that happens, and then the government says, well, we're not actually in a recession. It's like, well, okay, what does that mean? Well, there's an agency out there that actually has to declare that we're in a recession, your government at work. But they have not declared that yet, so therefore technically not in it, but we meet the definition that everybody agrees is a recession. And that's what this chart is based on. And we can see there in the middle, if you can read that, sorry for the small font, that's the unemployment rate. And when you talk about why the government is hesitant to call this a recession, and every single one of these recessions, the unemployment rate has already started to tick up. Okay, if you looked at this chart or could zoom in, the tick up in unemployment occurs before the recession occurs. And then obviously the gray areas there, you see an explosion in unemployment rate. The only one that's possibly different is COVID, where we're clipping right along, global pandemic, and we go right to, 14% inflation, but that was only temporary as we opened up the economy, and kind of all that went away, if you will. Not all of it, most of it went away from there. So when you look at from a recession perspective, if we're in one, then we would, if the chart that's unknowable off to the right, if there's going to be a big gray stripe that's coming up, we're actually set up perfectly for that. That the inflation rate would start to tick up and then go screaming higher, obviously with things that recession brings, inflation out of control, and unemployment as we slow the economy down. So I think that's why it'll be really interesting. It's always somewhat interesting to economists and investors what the Federal Reserve is saying, but it'll be really interesting on Friday with Chairman Powell's speaks at Jackson Hole, and whether he talks about whether we are or aren't in recession and the game plan for the Fed. I do think they continue raising rates. They may even continue raising at 75 basis points. So we'll see. If it's good news, if it's kind of hug it out, bunny rabbits and rainbows kind of thing, like we're past peak inflation and past peak rate hike. And he says we're looking hard at a likely 50 basis point raise then that means we're kind of through it, if you will. And if that's the case, we'll be in and out of a recession, not quite as fast as 2020 from the COVID thing, but we'll be out in short order and then life will be good again. So that's why everybody's kind of hanging on what the Fed is saying on Friday. Okay, let's switch over to home prices and not the market itself. Market is up a little bit today in the green, but home prices fell for the first time in 3 years. And that was a month over month fall and biggest decline since 2011. You can see the headline there. There are also folks out there that are taking a more dire approach. I do believe this. I think we are in a housing recession. I think that the data will prove over the next 6 months that the house prices are going to do nothing. But technically it says drop, but that's kind of almost too strong. I would say more reset, if you will, I think is a better descriptor of, it's like portfolios and people, the portfolio bubbles and it goes up and it touches a certain amount. And then every dollar below that is money that's been lost. It's like, well, you can make that argument all day. But no, we don't always measure things off of the absolute highest, right? So I think in this case that the market has gone higher, and I think now it's going to reset back to somewhat of a normal case, which doesn't do anything for you. If you just bought a house, yeah, you're probably going to be upside down in that house, if you will, for a while, right? When you look at historically at real estate markets, they tend to flatline for quite some time and then they jump and then they flatline. So I don't think you're not going to end up, it's not going to crash. I just think it's just the insanity that was the market with cash only buyers and no contingencies and all of that stuff. Those are all telltale signs of a bubble, right? So congrats on those that sold. If you bought, well, you're going to have to be patient again, and before you start making money on your house, and it may be a while before the next, crazy move up happens. So we shall see. But what can you do about it? Not much. There was an interesting at this briefing yesterday from First Trust. They talked about a standard home where a payment is $2,100 and the interest rate goes from 3 to 6%, which it has for mortgages. Then that same payment, same house, if you were to buy it, it would cost $2,900 a month. So around $800 move up. And then, so that in itself, we kind of already knew that, right? So interest rates go from 3 to 6. Well, that's obviously going to be a huge headwind. And it's going to be more interest that people are going to have to pay on that mortgage. Now, the math that they did that I think was more interesting is if you hold the payment constant and you say, okay, how much house can I buy for a $2,100 payment? At 3%, it was, this level of house. And then they did the math on how much less would the house have to be in order to have the same payment. And it was 28%. So, yeah. So if everybody only had the same amount of money to spend on housing, then, just the move from interest rates from 3% to 6% would cause a 28% reset in house prices. So a little bit scary, right? Because you may have 20% down. So you may truly be upside down if things reset to that level, but I don't think it will. I think they talked about even if the Fed continues to increase rates, short-term rates, again, they control the short-term, the longer-term mortgage rates shouldn't go much higher above 6. So you're not looking at that 7-8%. If you think back to the 1980s or 90s, when I first bought my house in 98, 7%, I thought I was thrilled with that rate. So we don't really think that's going to return. And also, me personally, I think we will overshoot raising interest rates with the Fed and then turn around and start lowering them. We kind of have done that recently, even though the Fed says, no, that's not the case. They're going to basically go up and stabilize. We shall see. I think it's easy to make the point that we need to lower rates, and when they're up at 3% or higher for the short-term rate, then you have some wiggle room to maneuver downward, where if they're sitting at 0, you do not have that maneuver room, right? So anyhow, stay tuned for the housing. I wouldn't be anxious to buy or sell right now. I would be kind of sit back and assess, if you will. All right, last thing, Tesla stock splitting 3-for-1 today. Obviously, that was announced early August, and it took effect. It's taking effect a lot faster than some of the others like Google and Amazon that were 6 months ahead of that, right? So let's take a look at the stock. Again, that a stock split is nothing more than exchanging like a $20 bill for $4 or $5 bills, right? So there's really nothing valuation wise, but it tends to help the stock. And I say that tends to, because it's one factor of, excuse me, of all the market factors that affect the stock. But you look at Tesla, at the beginning of or late last year above 1,200. Beginning of the year it was up above 1,100, dipped all the way down to 6. I don't know if it touched 5 or not in there, but low 6s or mid 6s, excuse me. And now back up to 900. So yeah, I think it is kind of a cult stock. You only own it if you believe that Tesla is much more than a car. It's changing the future. If you believe that, then you can pay the valuation, and we'll see how it all ends. I would not buy this stock just off of the split. I think you have to be in the cult. You have to believe the thesis. Don't just buy it because you think it's going to pop mathematically from a lower share price post split. I have to own that both Amazon and Google split and really did not pop. Other things were going on in June. The market was selling off pretty hard, but Amazon and Google have not benefited from splits like other companies have in the past. So that thesis is starting to not be as strong as it was, that you can just buy stocks that are splitting because it's a tremendous sign of strength. Well, I don't think you can say that. It's just one factor out there. I think it's a good sign when companies split their stock. So we shall see. But all right, that's all I have for you today. Thank you so much for listening. Please submit your questions as a comment through social media or directly to our email at VIP Services Ankerstar Wealth. And don't forget to like and subscribe. That's all we have for today's show, and we will see you back tomorrow.